Is Japan's economy in crisis? There's a lot of debate about the Japanese currency, the yen, which has fallen very significantly against the US dollar. This has led many people to ask if one of the world's largest economies is in serious trouble. However, today I want to explain why having a weak currency is not necessarily a bad thing for an economy, and also why measuring GDP, the size of an economy, simply by converting everything to US dollars and looking at it in nominal terms is very misleading and does not help us understand the health of economies around the world. This ridiculous simplistic view of nominal GDP leads Western pundits who don't understand exchange rates to make nonsensical statements about how the US economy is all powerful because number go up. Look at line go up. In reality, Japan is a perfect example of why nominal GDP, measuring all of the goods and services produced in an economy and simply converting everything to dollars with today's exchange rate, that is not a good way to understand an economy. It overstates the size of the US economy because the US prints the dollar, and it understates the size of economies like Japan or Russia, which do not use the dollar, and as their exchange rate falls against the dollar, it makes it look like their economies are in crisis. But as I'll be explaining today, your currency is not your economy. It is much more complicated than that. Now, in the past few years, Japan's currency has fallen quite significantly against the US dollar. In fact, this April, the Japanese yen was trading at around 160 yen for one US dollar, which is the lowest level it was at since 1990. You can see that in early 2021, the Japanese yen was trading at about 103 to the US dollar. And in the past 4 years, it has significantly depreciated. And I'm recording on the 30th of April, 2024. And today, the yen is at about 157 to the US dollar. So this is a very significant depreciation in just 4 years. What does this mean more concretely? Well, the median wage in Japan is about 400,000 yen per month. So if we take the exchange rate in early 2021 at about 100, we can see that the median Japanese worker was making about 4,000 US dollars per month. However, now at around 160, the median Japanese worker is only making 2,500 US dollars per month. So a decline from 4,000 US dollars per month to 2,500 US dollars per month in just about 4 years. A lot of people outside Japan do that calculation and they say, oh my God, this is a disaster. The Japanese yen is falling so much against the dollar. But in reality, it's much more complicated than that, because if you're in Japan, you're not buying things with US dollars. You're buying things with your local currency. And just because the currency depreciated against the US dollar doesn't mean that everything is suddenly significantly more expensive, especially in a country like Japan, which has a very large industrial base. And Japan produces many of the products locally that it needs for its economy. In fact, the weaker yen has made Japanese exports more competitive because they're cheaper for other people to buy Japanese products like cars and electronics. However, at the same time, it has also made imports in Japan more expensive, especially imports of energy. And Japan is very heavily reliant on importing oil and gas. And because oil and gas is still largely purchased in US dollars, and because the yen has fallen against the dollar, it makes it more expensive for Japan to import some of those commodities. So this is a double-edged sword, of course. I'm not saying that it's necessarily only a good thing that the currency has fallen. But what I'm also saying is that just because a currency falls doesn't mean that the economy is necessarily in crisis, especially if that economy is more self-sufficient in its industrial production, and Japan is still a major industrial power. And this is why these Western media reports claiming that Germany has overtaken Japan as a larger economy, these are actually quite misleading, because what these media reports are actually doing is simply looking at the nominal GDP in Japan, converting the size of all of the goods and services produced in Japan in 1 year, converting all of that to dollars. But because the yen has fallen against the dollar, we're supposed to believe that now Japan's economy is in free fall. In fact, inflation in Japan has been quite low. So even though the currency is falling, the price level is not increasing by very much, which means that a lot of average people in Japan are not necessarily being hard hit by the fall in their currency unless they're trying to buy foreign goods. If they're trying to import foreign goods, those will be more expensive. But if you're an average Japanese worker who is paid in yen and you're buying your food locally and buying Japanese products, your life is probably not really going to be that different. It will be more expensive to travel abroad, but in reality, again, your currency is not your economy. These things are not one-to-one. It's a more complicated relationship. And this is why it is so ridiculous that mainstream economists and Western media pundits so often use nominal GDP rates. They say, look, line go up. The US economy is doing so well. Look, it's so much bigger than China's economy. China bad, US good. But this is so simplistic because what this measurement does is it simply takes all of the goods and services produced in these economies and converts everything to US dollars at the current exchange rate. And this is why it looks like Japan's economy has been completely stagnant in the past several decades. And in fact, if you only use nominal GDP, you would think that Japan's economy has been in a severe crisis and its GDP has shrunk in the past few years from around $5 trillion to around $4 trillion. And this is leading to all of these reports saying that India is overtaking Japan in nominal GDP. And people also say, look, the European Union has been stagnant against the US economy. But in reality, a big reason for this significant increase in US nominal GDP against the EU, for instance, or against Japan, is simply because of the exchange rate. It's simply because the euro has fallen significantly against the dollar and the yen has fallen significantly against the dollar. In reality, if you actually want to understand the size of the economies, you have to use purchasing power parity, PPP, which is a measurement that looks at the purchasing power of the local currency in a given economy using a basket of goods that is similar across the entire world. And if you measure at purchasing power parity, you can see that despite the fact that the Japanese yen has significantly fallen against the US dollar or the euro has fallen against the US dollar, it doesn't mean that the purchasing power of that currency in local terms has significantly fallen. And if you measure GDP at PPP, you get a much more accurate assessment of the size of these economies that takes into account the inflation in the US, because US inflation has been quite high in recent years, and because inflation is high, it makes nominal GDP growth look higher than it actually is. But in reality, you can see that the US and the EU are at roughly similar levels, similar sizes of their GDP measured at PPP. And you can see that China's economy has actually been significantly larger than the US economy, and in 2016, China overtook the US as the world's largest economy. And what you can also see is that despite the fact that Japan's GDP looked like it was shrinking in nominal terms, in fact, Japan's economy has grown from about 4.5 trillion in 2010 to nearly 7 trillion today, 6.7 trillion today. And India's economy has actually already been larger than Japan. India overtook Japan in about 2008. So this is a much better measurement of GDP using the purchasing power of the currency locally in these countries. And this is also why these US pundits who don't know anything about basic economics will be like, look at this chart, number go up, US economy so strong, we number one. This is completely misleading. It does not help you to understand what's actually happening. In this case, I'm looking at this ridiculous tweet by Ian Bremmer, who is a US pundit. He's often quoted in the media as a so-called expert. He actually teaches at Columbia University, an Ivy League university, and he is the president of the Eurasia Group, which is contracted by many Western governments as consultants. But again, what you can see is that these US pundits are drinking their own Kool-Aid. They want you to think that the US economy is all powerful and China is weak. But in reality, simply looking at nominal GDP growth is looking at inflation and the appreciation of the dollar against other currencies. If the US has very high rates of inflation, it can also have very high nominal rates of GDP growth. It doesn't mean that it's real GDP growth. When you subtract the inflation, the nominal GDP can look very high, but actually be negative real GDP growth. The economy could actually be shrinking. And then when you look at the appreciation of the currency against other currencies, all this measurement can be is that the US dollar has increased in value against the euro or the yen, and therefore you think the US economy has grown. But in reality, this is simply a difference in accounting. And on the subject of accounting, one of the main factors in the calculation of GDP is government spending. So if your government goes into more and more debt and spends more into the economy, which acts as a stimulus, your GDP can grow quite rapidly. And this is exactly what is happening in the United States. In 2023, the US was running a deficit of 6.2% of GDP. The US government is running massive deficits that are the kinds of deficits that governments run during war. And yet the US is telling the world, look how strong our economy, look how great our GDP growth is, not mentioning the fact that ultimately this kind of deficit spending is not sustainable, especially in a country like the US that runs a massive current account deficit, a massive trade deficit with the rest of the world. And the US government has a federal debt of 122% of GDP. That has to be funded somehow. And in reality, one of the main countries that is actually funding this US government deficit is Japan. Japan is the largest foreign investor in US Treasury securities, US government debt. So in many ways, what we see here is that the US economy is this paper tiger that seems to be so strong, and all the Western media is claiming, how great the US economy is doing. But in reality, the US is exporting many of its economic problems to other parts of the world, including so-called allies like Japan that are militarily occupied by the US. And the US economy, its economic growth is partially being driven by a very strong US dollar. However, if your currency is very strong, that's not necessarily a good thing. The US dollar right now is very strong against other currencies, largely because the Federal Reserve has significantly raised interest rates, which I'll be speaking about more in a moment. But that's not a good thing for instance, US industry. The US government says that it wants to reindustrialize, but if its exports are extremely expensive because the dollar is so high compared to other currencies, that actually is going to probably make deindustrialization even worse. And especially for many poor countries in the global south, the strong US dollar is really hurting their economies, especially because many of them have their debt denominated in US dollars. And as their currencies depreciate against the US dollar, it makes it more and more difficult to pay off their debt. And because so many developing countries rely on importing commodities like oil and gas, which are often priced in US dollars, which means they have to get access to dollars in order to pay for those imports, which means that their currencies tend to fall even more as they try to get those dollars to pay for their imports. And this issue of industrialization is very important because right now the US government is constantly accusing China of being at so-called overcapacity and producing so much, and the US is trying to increase its own share of global manufacturing. In the past 3 decades, China's share of global manufacturing has gone from around 5% to 35% if you measure world gross production. And at the same time, the US share has fallen from a little over 20% to a bit over 10%. The US wants to increase its share, and Japan also wants to increase its share. Japan's share of global manufacturing production has also fallen from about 20% to a little over 5%. So ironically, the fall in the Japanese yen can actually help Japan to increase its manufacturing production output. And the rise in the US currency is going to make it even harder for the US. This is why the US government actually really wants to devalue the US dollar against other major currencies. But the US is in this difficult situation because it has very high rates of inflation. So it wants to bring down the inflation. But as the US tries to fight inflation, it's also leading to a stronger dollar. So the US government has to decide really if it wants more inflation over a larger period of time and a weaker dollar, or a stronger dollar but lower rates of inflation. By the way, another factor to keep in mind, which is very important, is that Japan for decades has had a very large current account surplus, meaning that Japan exports significantly more than it imports, unlike the United States, which for decades has had a massive current account deficit. So the US imports way more than it exports. And Japan has used its surplus in order to invest in US government debt. So as the Japanese yen falls against the dollar, it's actually likely to increase Japan's current account surplus because it will make imports more expensive and exports less expensive. And by the way, there's another important factor in all of this, which could be having an impact on Japan's monetary situation, which is the fact that Japan is the world's largest foreign holder of US Treasury securities. So the US Treasury market has been in a rocky moment recently because the US government is trying to bring down the yield on its bonds, which have been very high, nearing 5%. And that makes it more expensive for the US government to run big budget deficits to fund its debt. However, Japan has its currency falling against the dollar. So if Japan wants to strengthen its currency, the easiest way, the most common way, is that the Bank of Japan would sell some of the $1 trillion of US Treasuries that it holds and then buy back its own currency in the foreign exchange market. And that would increase the value of the yen against the dollar. So that could help to strengthen the Japanese yen. And it also could actually try to bring down the US dollar a bit. However, it also means that it would be more expensive for the US government to borrow because there will be more bonds in the market. And as the US government is trying to bring down its yields, this could actually bring up the yields. And of course, Japan is not fully a sovereign country. It's still militarily occupied by the US. The tens of thousands of US troops have been in Japan since the end of World War II. They're still there today. The Japanese government is very obedient, and it just follows really essentially what the US government wants it to do. So this is another potential complicating factor in all of this. So this brings me back to this issue with which I began the analysis today, which is about the Japanese yen. And I want to explain why the Japanese yen has been falling against the dollar so much, what this says about the Japanese economy, what this says about the US economy, and what lessons we can draw from this as we're going into an increasingly turbulent geopolitical environment around the world. Now, the simplest reason for the fall in the Japanese yen is because of the interest rates set by the central bank. This is not the only factor, but it's one of the most important. For over 2 decades now, Japan has had extremely low interest rates. In 1999, the central bank set interest rates at 0%. And then, in fact, in 2016, Japan began to impose negative interest rates, which means that if you borrowed money, you made money. I mean, this was a very crazy experimental monetary policy that the Bank of Japan was carrying out for decades. And even in the past few years, after the pandemic ended, when the US began to raise interest rates, Japan's interest rates were still around 0%. Now, the Federal Reserve, the US central bank, was carrying out a similar policy of low interest rates or zero interest rates for over a decade after the 2008-2009 financial crisis. But with the stubborn inflation after the pandemic, the Federal Reserve significantly raised interest rates from roughly 0% in 2020, 2021 to 5.33% today. This was the fastest rate at which the US had raised its interest rates since the late 1970s and early 1980s. So today in the US, you have interest rates of 5.33%, but in Japan, they're around 0%. That's a huge spread. So what this means is that many investors who had held assets in Japanese yen have sold off those assets and instead invested in US dollar assets, because now US assets tend to have much higher returns because of the rising interest rates in the US. Now, the clearest way to see this is to look at government bonds, that is, government IOUs, debt. And economists tend to look at the 10-year bond yield because it gives you an idea of what investors think about the health of the economy. And you can see that in 2019, the 10-year Japanese bond yield was negative. And into 2020, it was still negative. So if you bought a 10-year government bond from Japan, that is, if you lent money to the Japanese government, you were actually paying Japan in order to lend your money to Japan. However, what we've seen in the past few years is they have slowly gone into positive territory. And today, Japanese 10-year bond yields are about 0.7, 0.8%, so slightly under 1%. Now let's look at US government bonds. Now, in 2020, the return on a 10-year US government bond was about the same level that they're at in Japan today, about 0.7%, 0.8, and then around 1% in 2021. But as the Federal Reserve has significantly raised interest rates, now the return on a 10-year US government bond is over 4%. That's actually a very good return. So why would investors hold Japanese government bonds in yen if they can instead convert their yen to US dollars and buy US government debt and get a much better return? And this is exactly what many investors have been doing. And not just that, investors have also been using the weak yen to borrow at low interest rates and then investing that in US dollar denominated assets. This is known as a carry trade. So because interest rates are so low in Japan and because the yen is so weak, it's very affordable to borrow. So if you're an investor, you can borrow large sums of Japanese yen at low interest rates, and then you can convert those yen to dollars, and then you can invest in US dollar denominated assets at a higher yield, and then you have a differential there. And then what happens is that you can eventually pay back those yen, but with the interest that you made on those US dollar denominated assets, you made a profit. So what this means is that investors have been incentivized to basically speculate against the Japanese yen, which has only led to a further fall of the Japanese yen against the US dollar. These are some of the main factors leading to the fall of the Japanese currency. So this raises the question, why has the Bank of Japan not raised interest rates in order to prevent the capital flight of investors moving their capital into US assets? Why has the Bank of Japan not followed the US Federal Reserve? Well, there are two main reasons for that: debt and inflation. The most important factor is that Japan's national debt is absolutely off the charts. It is astronomical. Japan's public debt as a percentage of GDP is over 260%. That is the largest on earth. The US government has a very large federal debt of 121% of GDP, but Japan's is over 2 times that, 261% of GDP. But one of the main reasons that Japan has been able to maintain such high levels of debt is because for decades, the interest rates have been 0 or negative. So there are basically no consequences for the government to keep on taking more and more debt. But if those interest rates are risen significantly, then the Japanese government will have to spend even more in order to service its debt. And when you have debt at over 260% of GDP, that's simply not manageable. Although what is interesting about Japan's economy, and rather unique, is that the Bank of Japan, the central bank, actually owns the slim majority of all of the government bonds. As of last year, it was 53% of government bonds were held by the Bank of Japan. So it makes the situation in Japan a little different. And by the way, it was in fact Japan that created the policy of quantitative easing starting back in 2001. This was before the 2008-2009 financial crisis, after which the US Federal Reserve and the European Central Bank, they also adopted the policy of quantitative easing, in which, for instance, the Federal Reserve, the central bank, was actually basically printing money and then using that money in order to buy the Treasury's debt, the Treasury bonds. So the Federal Reserve became a large holder of US government debt, while in Japan, the Bank of Japan is the owner of over half of the government's debt. So that is a unique aspect of the Japanese economy, which could potentially make it easier for the government to eventually deal with its debt problem. Unlike in the US, where many investors around the world hold large sums of US Treasury securities, it makes it more difficult for the US to deal with its massive debt of over 120% of GDP. But debt is not the only reason that Japan has refused to raise interest rates. Another reason is inflation. Now, going back to 1999, when the Bank of Japan first experimented with the ZIRP policy, zero interest rate policy, which has continued since then, going back to 1999, the Japanese central bank was trying to increase inflation because something unique about the Japanese economy is that for decades, Japan has dealt with very low rates of inflation. And in fact, in some years, Japan has had deflation, where instead of prices increasing, in fact, prices have decreased, which is actually quite bad for the economy because it can lead to a loop, a doom loop, where consumers say, well, why would I buy something now if the price could fall in the future? So they don't buy anything, which leads to a decrease in economic activity. And then that's a self-reinforcing positive feedback loop. So for years, the Bank of Japan has tried to increase inflation. That's why it had zero and negative interest rates, trying to encourage inflation with this very loose monetary policy. And recently, after the pandemic, inflation has finally rose a little in Japan and has been about 2 or 3%, which after a decade of basically 0% inflation, this is actually something that Japan saw as favorable. But one of the reasons that inflation had been so low in Japan for so long is because wages were low. In fact, for 30 years in Japan, wages were stagnant. And it was only last year that finally the average wages in Japan began to rise. Part of that was because the government was pressuring companies to increase wages in order to increase consumption, in order to boost inflation. And this is exactly what is now happening in Japan as wages have risen, and also because of global supply shocks due to the pandemic, also because of the war in Ukraine and geopolitical uncertainties. Inflation has creeped up a little bit in Japan, but it's still significantly lower than in many other major economies. Compare that to the United States, for instance, where inflation has been significantly higher. In June 2022, it hit 9%, and it's still between 3 and 4%. And this is despite the fact that the US Federal Reserve had raised its interest rates to 5.33%, whereas in Japan, interest rates are around 0, and inflation is still between 2 and 3% lower than in the US. So this shows that Japan does have some economic problems that it itself created after decades of stagnant wages, after decades of this zero or negative interest rate policy. And now Japan has its currency significantly weakening against the dollar. But if the central bank raises interest rates, it might bring down the inflation and go into deflation once again. And it also might make it very expensive for the government to service its massive debt. And finally, this brings me back to the issue I was discussing earlier of the very strong US dollar and the issue of US Treasury securities. Because Japan, if it intervenes in order to try to strengthen the yen against the dollar, the Japanese central bank will probably sell some of the $1.14 trillion of US Treasury securities that it holds. However, what that means is that as there are more treasuries in the market, it will make it more expensive for the US Treasury to sell more debt because the yields will have to be higher. Investors will demand higher yields. So Japan is in the situation where it wants to maybe strengthen its currency, but the US might not want Japan to strengthen its currency if it involves selling treasury securities. And again, the US still has tens of thousands of troops occupying Japan. And this also comes at a time, by the way, when the second largest foreign holder of US Treasury securities, China, has been dropping its holdings. This is the most recent data from the Treasury's website. It shows the major foreign holders of Treasury securities, of US government debt. You can see that in the past year, China's holdings of Treasury securities have actually dropped. In 2023, in March, the People's Bank of China had $869 billion of US Treasury securities. As of February of 2024, that had fallen to $775 billion. And in the past decade, China's overall holdings of US Treasury securities have been declining, whereas Japan actually has increased its purchasing of US government debt. In February of 2023, the Bank of Japan had $1.08 trillion of US Treasury securities. As of February of this year, the Bank of Japan had 1.17 trillion. So Japan is increasing its holdings of US government debt, whereas China is decreasing its holdings of US government debt. China's holdings of Treasury securities, US government debt, peaked in 2014, and they've been consistently falling since then. And it makes perfect sense why. The US government has weaponized its currency. The US government already established the precedent of seizing the US dollar-denominated assets held by the central banks of Iran, Venezuela, Afghanistan, and Russia. And now there's a huge debate in the US about whether or not the US and the European Union should steal the $300 billion worth of Russian central bank reserves that they already froze, and whether or not they should steal that money and use it to fund Ukraine. So now we see central banks around the world are moving to de-dollarize, at least diversify the reserves, because they are afraid they could be the next victims, especially China. And now in China, many economists and political scientists are saying very clearly that the government should drop even further its holdings of US Treasury securities because they could become so-called hostages of the US. So this is de-dollarization. China is de-dollarizing, Russia has de-dollarized at a very rapid pace, and even many other countries around the world, even historic US allies like Saudi Arabia, are gradually de-dollarizing. So this is the situation that Japan is in. I'm not saying that Japan is, in a perfectly great situation. Its economy is super healthy and everything's looking awesome for Japan. No, I mean, this is a very long and complicated analysis today. I'm not just doing one thing. I'm trying to explain the different moving parts we see in the world economy. But with the shifting geopolitical situation, you can see that Japan is in quite a bind, right? Because Japan's currency is falling against the US dollar. It's not necessarily a bad thing. It could help increase the competitiveness of Japanese industry and exports, but it also causes some other issues like increasing costs of imports of energy. And if Japan wants to maintain the value of its currency against the dollar, or even, wants to increase the value of the yen against the dollar, Japan will have to sell US Treasury securities. But the US government wants Japan and China and other countries to buy US Treasury securities while the US is weaponizing its Treasury securities, while the US is trying to decrease the yield on its Treasury securities in order to make it less expensive to borrow because the US has debt at 120% of GDP. But at the same time, the Federal Reserve can no longer engage in quantitative easing as aggressively as it did in the past because the US government is also trying to bring down inflation. So if the Federal Reserve tries to go back to quantitative easing and tries to control the yield curve by buying securities to bring down the yield, what that will do is probably bring back significant rates of inflation. And especially with an election coming up this year in 2024, that's the last thing that the US government wants, is higher rates of inflation. So there are all these many moving parts in the US, in Japan, in China, in Russia. It's very complicated. And hopefully I helped you try to understand at least the basics of what's happening in the global economy and in geopolitics, which is becoming increasingly complex. And that's why it's very important to understand these moving parts, especially because oftentimes the Western media doesn't do a good job, especially when it comes to the geopolitical issues, because the Western media is very biased in the interest of Western governments. That's why I created Geopolitical Economy Report. I'm Ben Norton, the editor-in-chief. And here at Geopolitical Economy Report, our mission is to educate people on these very important developments in the world today. Please like and subscribe. Please consider sharing. And I will see you all next time. Thanks a lot for joining me today.